Mr. Speaker, sir,
Patrick Chinamasa has projected a rebound in the mainstay agricultural sector from minus 3.7% to 12% on the back of increased maize and tobacco production. The mining sector will grow by a marginal 0.9% as prices of major commodities firm. But the supply side has been the lesser of the two problems for Zimbabwe. Containing expenditure has been the persistent thorn in the flesh. Maintaining fiscal discipline will be the test in 2017.
The biggest challenge is making sure that allocation of the scarce foreign currency that we have is going towards those manufacturing companies that he is supporting. This is going to be where the proof of the pudding is going to be in the eating, is when we see alignment of policy, because sometimes we see a good policy matrix like that, but the implementation now.
The trade deficit is expected to narrow to $1.5 billion, still unsustainably high and likely to keep the market short of liquidity. Bond notes introduced to help ease the crisis have been well received.
For us as manufacturers, any position that enhances the ability to purchase, the ability to transact, obviously spurs on economic activity, and the Minister is absolutely on point.
Buoyed by dividends that followed clearance of long-standing arrears to the IMF, Chinamasa is aiming to pay off obligations to other international finance institutions in the new year. But an international bailout has failed to materialize, limiting his chances of meeting that timetable.
It has to come from domestic resources, and I don't think government will be able actually to make a significant impact on that front. I don't think we are going to clear our arrears before 2018, in light of the huge pressures on fiscal expenditures leading to the elections, and also the anticipated poor performance in terms of revenues.
The tax base has been shrinking due to company closures. A high-cost environment has been blamed for suffocating businesses and rendering exports uncompetitive. A moratorium on price and salary increases across all public entities has been proposed.
We need to look at how we reduce costs, not increase costs. I think that's the message. However, from a private sector point of view, because we import a lot of raw materials, there is a little bit of a lack of latitude sometimes to be able to keep prices down. Because if you are importing palm oils, if you are importing certain raw materials that we don't produce as a country, you're susceptible. Then you have to stay viable.
Inflation is projected to rise to 1.5%, breaking out of deflation territory and signaling a growth in aggregate demand. Farai Mwakutuya, CCTV, Harare, Zimbabwe.